Shall we get started? Good. Well, welcome all. My name is Jim Chambers. I'm a member of the Board of Trustees of the college, and I'm the chair of the Sustainable Investments Task Force, which is the group that sits before you today. And we've been hard at work since the spring semester, looking at the question of divestment of the college's portfolio of fossil fuel investments. Top 200 companies investing in fossil fuels. There was a conversation that came basically generated by students and a lot from the Reinvest Dickinson group. I think a lot generated from McKibben's speech in the spring, and some very well-informed conversation from people coming to the board, investment committee, and asking for Dickinson to follow and sign on to the question of divesting the portfolio of our endowment from these particular investments. So there was conversation back and forth. I think at many levels there was some very rich conversation at that point. But as we got into May, into the late spring semester, the trustees, in conjunction with actually input from the students, administration, faculty, all decided, well, this is a very fair question. Let's go about this the way we go about most things at Dickinson and have a community conversation about this. So that's why this task force was charged with examining the question. And our primary job is to come back to the investment committee of the college with a recommendation on to divest or not to divest. But at the same time, we want to have a conversation and open this to the broader community to get as many inputs as possible, because we as trustees, I know, value that aspect of our governance at Dickinson probably above most anything else. So with that, the trustees and the administration asked a number of people to participate in the task force. Again, those in front of you. And I'd like for each of them to introduce themselves. And then I'll tell you a little bit about our work. I want Steve to speak a little bit about the technicalities and some of the complexities of our endowment as it stands just for education purposes, because that's kind of the baseline for all these conversations, and then open it up for more discussion and conversation. So as I said, I'm Jim Chambers. I'm on the Board of Trustees. I think I joined the trustees in about 2007. I'm on the Finance and Budget Committee. I am not on the Investment Committee. I'm also on the Campaign Steering Committee, and worked on the Presidential Selection Committee last year. So those are the primary areas where I spend my time. So with that, Michael, do you just want to?
Michael Fratantuono. I'm a professor in the International Business and Management and International Studies departments.
I'm Michelle Fisher. I'm the support staff representative, and I work in admissions.
I'm Neil Leary. I'm the director of Dickinson Center for Sustainability Education.
I'm Mara Donaldson. I'm a professor of religion. I've been here since 1990.
I'm Will Katitsky. I'm a sophomore.
My name's Adam Laird. I'm a senior economics major.
My name is Steve Hitch. I'm Associate Vice President for Financial Operations and Auxiliary Services.
Terrific. Thank you all. So what have we been doing since we got together? And well, we've spent a lot of time together. And first and foremost, I want to thank this group in front of you for volunteering or to be involved in this, because it has taken a good chunk of people's time. We have had 8 substantive, we had an organizational meeting followed by 8 substantive meetings up to this point. We have at least one more next week. A lot of work outside of those meetings, and so these people have put an awful lot into it. And so on behalf of the trustees, I'd like to thank everyone up here today for doing that. And so in the structure of those meetings has been broken into 2 basic parts, and what we have up in front of you is our work plan for the task force. The first part of the plan is was very specific to understanding the endowment and how it works, And, and you can see going through here, I won't read it all to you. We wanted to get the position from everyone. We wanted to get the basics of the endowment, which Steve is actually going to go over with you some today. How we use the endowment, how the returns impact the overall finances of the college, how we model things so that we know what we're doing with the finances going forward. Then we spent, what was very important was our unique way that we, fairly unique way that we manage the endowment. We brought our investment manager in, a firm called Investure that is run by a woman named Alice Handy, who has performed extraordinarily well for the college since we hired them in 2008? 2006. Okay. And have provided outstanding returns to us when you look at almost any benchmark for endowment investments. So we wanted to understand how they operated and then also probe them a little more about sustainability, how they look at those investments, what they're doing about it, and how that would impact us on with the Dickinson endowment. If you want to go ahead, Steve. Then we actually in the first part of the meeting, first part of the work plan, excuse me. We also looked at, well, what are the costs of leaving, and what are the potential effects on our returns is the big part of that that whole section of discussion. Then we went into getting some input from both the advancement office, the development office, and the admissions office. What are we hearing out there from our alumni, from potential students about this question? What's going on out there? And then Professor Fratazzuano put on a wonderful panel discussion that was attended by two alumni involved, one involved in alternative energy investments, one a lobbyist in the broader energy sphere, and then Professor Underwood provided us a lot of good data there as well. So we had an excellent panel discussion to talk about perspectives from the outside on that. Then we wanted to talk some about, okay, how is this parallel with maybe apartheid and other socially responsible investing? And Professor Donaldson did a tremendous amount of work on that, and we got some very good input there. And then we had to hear from the legal department, of course, about what are some of the legal considerations that we have to think about as we start tinkering potentially with the endowment. That really was the first half of the work plan. And what you see here then is, so we wanted to talk about that. The core question was part one. But then part two was all about, well, if we have an opportunity, let's try to use our time well. So you will hear today, and you probably have heard, that there are some extremely difficult issues around divesting of our portfolio, okay? And so if that's the case, well, what else is going on with sustainability? And if we have an opportunity to be together, what else can we look at and perhaps use our voice to be heard with the administration and the trustees even more? So we walked through and we got to look at what are we doing with the curriculum, what are we doing with the buildings and grounds. We had Ken Schultes was very involved with that. What are we doing with the community? And Ken and Professor Leary also told us a lot about what was happening there and our impact there. We then spoke about the ACUP climate commitment that the school has signed on to, where we have requirements for the year 2020 to meet, and some of the requirements about that and what we're doing about that. Involved in that is discussion around a sustainable revolving loan fund that I know a number of you have interest in. And then we at our final meeting, we did hear, that's not up there, Professor Leary gave an update on the IPCC report from the scientists, the worldwide consortium of scientists around climate change. And then we began to discuss, all right, what are we going to do about this? And we have another meeting next Tuesday about formulating our recommendations to the task force. So that's kind of been the model of our work. Committee members, anything I missed or anything you want to emphasize in that? Okay. Well, with that, and we'll be respectful of time because we do want the majority of time open for questions and discussion. But we think it's important that Steve give kind of the fundamental view of how our endowment works, since this is core to the question. So if you want to go ahead with that, Steve. Perfect.
Okay. I will try to be quick. As Jim said, we thought it would be important that everybody have a basic foundation of knowledge about some of the things that we're facing financially, as well as how the endowment works and how it's invested. Jim already mentioned through Investure, and that's a key piece of this. We did receive questions in advance of the meeting from some of you, and I was pleased to see actually that a few of those questions did ask about our endowment, how it works, how it's invested, things of that nature. So we accurately anticipated some of the things that you would be requesting. Again, though, the purpose of this forum is to have a lot of time for you guys to ask questions and for us to answer those questions and engage in a dialogue. So I'm going to try to go quickly, but again, if I go too fast, if I gloss over something too readily, please stop me and ask me a question. What I want to start with is there was a report done by Moody's Investor Services in January of 2013. And Moody's is a rating agency, and they rate the creditworthiness of businesses, of institutions of higher education, et cetera. And they did a report on the entire higher education industry, and you can see some of the key points from that report. And they're kind of troubling, actually. The entire outlook for the entire industry was negative, whereas previously it had been stable. There's mounting pressure on all revenue sources. Price sensitivity is an issue, and we talk about this all the time as tuition, fees, room and board go higher and higher. And in the end, they concluded that bold action was needed by higher ed administrators in order to sustain the higher ed industry. So that's the environment in which we're working, in which we're trying to not only keep Dickinson as a viable institution, but improve it. And the finances are critical to this, and we're going to talk about our financial situation and the role that the endowment plays in that. The other thing that came out of the Moody's report, I thought this was an interesting chart because I think in a very brief snapshot, it shows you the importance of financial resources to an institution. And what they've done here, they've shown you some statistics for institutions on the left-hand side that are rated AAA, and that's their highest rating. And then on the right-hand side for lower-rated institutions at BAA. And probably the key piece of information is that differentiates these institutions is the AAA ones have over $1 million in financial resources per student, and the lower rated ones have only $23,000 in financial resources per student. But those resources translate into a lot of different things. Number one, these will always have almost universally a lower selection rate, indicating that they are more competitive institutions. Matriculation rate of the students who are admitted, how many actually enroll, 50% here versus 24% here. We're at about 25% of those students that we admit. Net tuition per student is not that much different, and yet despite the fact that these institutions charge about the same amount of tuition, look how much more money they invest in the education, and that is because of the financial resources they have. So that is coming from endowment, and that kind of highlights the importance of an endowment to the success of the institution. Just to show you a little bit of history, what we've been through, I know you guys have been here anywhere from 1 to 3 years, but way back in 1991, which really isn't that long ago, our tuition fee, room and board charge for a full-pay student was under $19,000 a year. And in this current fiscal year that we're in right now, it's almost $58,000 a year. So it has risen very dramatically. And that has been quite a challenge, keeping a Dickinson education affordable to our students. And again, the endowment is more and more important in doing that. If you look over that same period of time, the average tuition increase, this is tuition fee, room and board, has been a little over 5%. Whereas the average increase in the Consumer Price Index has been about 2.5%. And the Consumer Price Index is roughly equivalent to people's incomes, and it would be reflective of their ability to pay. So that's another challenge we're dealing with, is we're getting to that price sensitivity point that Moody's talked about in their report. What we did here was we looked at Had we increased our tuition, fee, room, and board consistent with the CPI over that period of time, what that aggregate increase would have been, and it would have been 66.5%. If we stayed at 3.5%, and that's what our tuition, fee, room, and board increases have been over the past couple of years, it would have been about a 120% increase. What we actually had, though, with our 5% average, because of the compounding that goes on, our tuition, fee, room, and board has gone up by 187% over that period of time of about 20 years. And what we did here was we looked at, had we, again, confined ourselves to the CPI increases or the 3.5% increases, what would that have meant for us as an institution in terms of how much annual revenue we would have available for our operations? And to give you an idea of scale, our annual budget's just short of about $120 million. Had we confined ourselves to the 3.5% increases, we would have about $21 million less annual revenue to deal with each year. Had we confined ourselves to the CPI, it would have been $39 million less revenue. And the point we're trying to make here is going forward, we are not going to be able to increase tuition by 5% a year. We will be lucky if we were able to increase tuition by 3.5% a year. And we're going to be discussing this at the Planning and Budget Committee meeting. And I know already I've heard from students who don't want to see a 3.5% tuition increase. And yet the cost of providing the education continues to go up. So we've got to find the funding from somewhere to remain viable and competitive. Financial aid. As you know, we try to meet all financial aid. We do our best to do that. But with the tuition going up, that means need is going up as well. And the important bars to look at here are the red ones. It looks at the total institutional grant, what we've awarded in financial aid over the past several years. And just in the past 7 years, that financial aid has almost doubled from $23 million a year to almost $40 million a year. And it did in this current fiscal year surpass $40 million. The vast majority of that financial aid is unfunded. We don't have scholarship funds to supplement that tuition discount that we give to people. So that is a very critical factor that we try to monitor. We try to have the highest quality class we can have with the demographic characteristics that we're seeking, to have diversity in our class. And it's a bigger and bigger challenge every year because we only have so much financial aid money to deal with. And then this kind of looks at our financial aid, or excuse me, our discount rate compared to all private not-for-profit schools that report to NACUBO. And as you can see, there really isn't a whole lot of room to go because we're already below the average in most years. I mean, some people say, well, bring in more full-pay students, bring down the discount rate, that'll free up more revenue. But that is really not an option. We're actually doing quite well right now compared to our peers in managing that discount rate. Now let's get to the endowment part, now that we've established the financial landscape within which we are operating. What an endowment is it's actually a collection of funds, and there were over 800 different funds in the endowment, and each of those funds is either established by a single donor or by a group of donors, and the fund is established with a specific purpose. And it is meant to exist in perpetuity, so we can't just go and take the endowment and spend it. We can only spend the earnings off of the endowment. And so what we do is we invest that money, and then we take the earnings off of it every year, and we use it to support the operations of the college. And those schools that have a large endowment, as you saw, they can have all kinds of resources to devote toward education, and those schools that have a smaller endowment cannot. And that differentiation, as things get tighter and tighter, that differentiation is going to become more and more significant. We're going to talk, I'm sure, over the next hour or so about our investments in fossil fuels. And just to give you an idea, 350.org has requested that institutions divest their endowments from the top 200 fossil fuel companies. So just to give you an idea of the composition of our endowment, about 1.1% of our endowment, the part that we control, that is the pooled endowment that is invested with Investor, you heard Jim talk about them, is invested in the top 200 fossil fuel companies. So actually a very small portion. If you look at total fossil fuel investments, not just the top 200 companies, but smaller companies as well, it's about 4.2% of our total endowment. And by comparison, the S&P 500, which is a pretty good approximation of the public equity markets, is about 10% in fossil fuels. So we are already invested pretty lightly in fossil fuels. By contrast, about 6% of our endowment is invested in what we'll call sustainable investments. And we got some questions on how we define that. We can go into some more detail upon that later. But right now, just for brevity's sake, we're defining that in two ways. Number one, companies which meet ESG requirements, which is environmental, social, and governance requirements. And number two, companies which are engaged in alternative energy. Okay, let's look at our endowment versus some other institutions with which we like to compare ourselves. And as you can see, on the left-hand side there, this looks at endowment per FTE, by the way, so that controls for the different sizes of institutions. As you can see on the far left, we have Swarthmore, we have Wellesley, we have Bowdoin, we have Middlebury. These are all very highly prestigious, high-quality, very competitive institutions, and as you would imagine, they're the ones with the larger endowments. We don't compare very favorably to them. We're doing a lot with the endowment that we have, and something that I know I used to hear here on campus a lot. I'm not sure if it's still running around, but we talk about punching above our weight or fighting above our weight, and that's what we're talking about. We're doing as much as we can with a lot less resources than schools we're competing against. These are the ones that we like to consider our direct competitors because these are our applicant overlap institutions. You know, we like to compare ourselves to Swarthmore, but we don't have too many applicant overlaps with Swarthmore. We have overlapped applications with all of these institutions, and you see even at that, even at this self-selected market that is defined by the students' applications, we are average at best compared to the other institutions when you look at the endowment per full-time equivalent student. Let's talk just a little bit about the investor consortium because that's critical to understanding the divestment issue. What we do is, you've probably heard a couple different figures about our endowment. You've heard a figure as high as $400 million. That includes some other investments that are held in trust by others and that we do not have control of. We have absolutely no say in how those are invested. They're invested by others on our behalf, and we receive the earnings off of that. But the portion that we control is the pooled endowment, and that is invested with Investure, which is the company that Mr. Chambers made reference to. It's based out of Charlottesville, Virginia. And what Investure does is they actually pool the endowments of 13 different organizations, including us. And by doing so, there's about $10 billion total that they have under management. And through economies of scale, we are actually able to get much higher level and much more sophisticated investment management services by pooling our resources with others than we could get going out on our own. We are much too small to hire an in-house investment office or to go out on our own and hire a manager that's going to give us a customized portfolio management. So by pooling with these other institutions, we are able to do that for a comparatively low fee. The other thing to understand about this, well, the first thing, the implication of that, having our funds invested with the other Investor Consortium members, is if we are going to make an investment decision, all of the consortium members have to agree with that. We've discussed divestment with the other consortium members. There are one or two that for them it is an issue, but for the most part it is not an issue for the other consortium members, and they are not in agreement on divesting the funds. So to divest from fossil fuels absolutely would mean that we would have to leave the Investor Consortium, and I'll talk to you a little bit about the implications of that in just a second. And by the way, just one thing I will comment on. I was here to see Bill McKibben speak, and he's very charismatic, and I enjoyed his speech very much. But he wasn't quite correct in one of the comments that he made. He said that Middlebury uses the same investment advisor that we do, and all we have to do is tell them to divest. They are not an investment advisor. They are an outsourced investment office. And again, they are not just advising us, they are investing our assets on our behalf along with the assets of the others. So we could not simply tell them to divest because our funds are pooled with all others. So Mr. McKibben was not understanding that situation correctly. The other thing it's important to understand is even the investor pooled funds, they will go out and they will hire fund managers. And in addition to our funds being pooled within the investor pool, they will contract with a manager who has not just Investor as a client, but who has other clients as well. And the investor assets may represent 10, 20% of that manager's total assets. And in order for that manager to divest, he or she would have to have agreement from their other clients as well. So probably about 70% of the investor dollars are pooled with managers who serve other clients as well. So that would be another problem, even if all of the investor clients agreed to divest. Okay, let's look at how we've done with investor. What these bars represent are our percentile rank in comparison to all the other institutions of higher ed as far as the returns on our endowment. And with investor, we have done very well. Our one-year returns, actually, these are based on June 30th of 2012 returns, by the way, because we don't yet have the comparative data for June 30th, 2013. We were in the 84th percentile for our one-year return, looking back from 6/30/12. We were in the 90th percentile 3 years back, the 91st, looking 5 years back, and looking 10 years back, we were in the 92nd percentile. That is unbelievable performance. It truly is, because everybody out there is doing their very best to get the highest returns at the lowest possible risk. And to consistently be in the top 10 or 15% is just phenomenal, particularly for an institution like us. I mean, there are years when we have beat Harvard, we have beat Yale, and they have $30 billion, well, Harvard has a $30 billion endowment. And that is something that Investor does bring to us, and that's been part of our considerations, because we do understand that if we were to divest, we would have to be giving that up. Now, the question's been asked, what would we be giving up if we left Investor and we couldn't earn as higher returns? And what we did here, just to kind of give you an idea of that, is we compare ourselves on our 1, 3, 5, and 10-year returns again to the 75th, 50th, and 25th percentile of other institutions. And probably the best figure to look at, because it represents the return over the longest period of time, is the 10-year returns. And you say, okay, we earned 8.1% over 10 years. You know, what if we could achieve the median, 6.16%? It's only a couple percentage points. Maybe we're lucky. Maybe we get at the 75th percentile. Over the course of time, particularly when you take into account the fact that not only are we having earnings every year, but we're spending a good portion of those earnings. So if we earn 6.9%, every year we spend 5% of that, then our earning is really 1.9% versus 3.1%. So, you know, just that little bit, you end up with 50% greater earnings just from 1 or so percentage points. So what we did here was we tried to show you, and there's 2 of these models here, and up at the very top, I color-coded this so it would hopefully be easy to follow. You see Dickinson's returns, 1, 3, 5, and 10 year, and those are coded in yellow. And then you see the median returns, the 50th percentile, 1, 3, 5, and 10. And that's that 6.16% that's coded in green. And if we were to take, at the time when we ran this, our pooled endowment value was $322 million. If we were to take that over the next 30 years with the 8.1% rate of return versus the 6.16% rate of return, and also factor in a 5% spend rate every year, and again, that magnifies the difference between those two. At the end of those 30 years, we would end up with an endowment of $805 million under the 8.1% return. Under the 6.16, we would end up with an endowment of $455 million. So we'd be at almost double from that little bit of difference in earnings. What if we were lucky, though? What if we earned at the 75th percentile? And that's a leap of faith, because, again, there's some very good people out there that we'd have to beat 3/4 of them in our returns. So let's run it at the 6.9%, and we see that, again, at the end of the 30-year period, we'd be at $805 million versus $566 million. And I know we've gotten some questions about the value of money and what's really important and this and that, and we'll be happy to discuss those. And you know, some of these are philosophical questions on which we may never agree because they're matters of opinion. But the Board of Trustees and the administration is charged with not only maintaining Dickinson as a viable institution for the present day, but also maintaining Dickinson as a viable institution for perpetuity. And this is a serious issue that we have to deal with in our plans to maintain Dickinson, and particularly in light of what we discussed early on in the presentation, as the finances get tighter and tighter, as we are less and less able to depend on growth in net tuition revenue, institutions are going to become more and more reliant upon those endowment resources. And you already saw the ones with the high endowment are the ones that are succeeding. So as we look for our long-term strategy for Dickinson, the endowment very much has to be a part of that strategy, and growing that endowment has to be part of our strategy too. And we feel pretty confident that if we were to divest, in order to divest ourselves of the 1.1% of fossil fuels that comprise our endowment, there would be very significant consequences financially for the institution. And that's just kind of a summary. Okay, thank you.
Terrific. Thank you, Steve. All right, with that, we'd like to open it up to conversation. We have had some questions submitted, but I think we can open it up to the floor. We can certainly go to those questions if we need to, but I'd just like to take it from the floor. Anyone, feel free.
Can you please use the microphones when you ask questions also, because we are recording this and we want to get your voices.
I'm right by the microphone, so maybe I'll just
Good.
show everyone where it is. Hi, I'm Professor Pauly. I teach environmental history. Nice to meet y'all. Thanks very much for this presentation. I really appreciate the amount of time that you guys have spent thinking about these issues, and I feel like I can see that a serious conversation has gone on. And Steve, thank you for your presentation. I feel like I'm learning from your presentation, as from our many planning and budget meetings. Money is tight, and money is important. And I understand that. I have a couple of questions, though. In particular, I was interested to see when you talked about the meeting with the investor representative, that she talked about some of the consequences of divesting, some of the justifications why investor won't divest. And I was surprised to see that she didn't mention the carbon bubble, which has been reported in the Wall Street Journal and in Forbes, and a number of other mainstream economic and business papers, which is, for those of you who are not familiar with it, the idea that fossil fuel companies spend a huge amount of their resources looking for new reserves which they cannot burn. And so they are grossly overvalued, and their high stock price is actually a kind of exposure. And I definitely appreciate the fact that, when we talk about money, when we're sort of putting money against values, those questions are very hard to address, and those are questions of matters of opinion. But I do feel like I don't know that we should let practicality be all on the side of not divesting. So I think the carbon bubble, I guess, have you talked about the carbon bubble? I also noticed that she talked about the dangers of restricting funds. I was wondering if the committee had seen, and I'd be happy to forward it to you, the report from the Apereo group, which challenges the idea that restricting funds really decreases investment. And I realize that these are all conversations that you would have to have with investor, and I think that the consequences of leaving investor are very serious, but I'm not sure that I see that the conversation with investor is really over, because I think if they're not talking about those things, they should be. Finally, I definitely understand the way in which the endowment is cut into lots of tiny pieces, first by investor and then handed to hedge funds. We can't trace and track all of those things. But my understanding is we don't invest in guns. Is that so? That was said at a faculty meeting a couple of years ago.
Yeah, I said that myself. So.
Yes. So I was wondering how that was achieved.
Yeah,
Thanks very much.
It wasn't too long ago, Emily. It was maybe within the past 6 or 7 months. The question came up at a faculty meeting, and it was a good question, and truthfully one that we hadn't asked previously. Did talk with investor about that, and we did have investments, if I remember correctly, in 5 or 6 companies. They were all engaged in defense contracts. There was nothing that dealt with domestic firearms. Now, I don't know for sure that investor has made a conscious decision not to invest in domestic firearms. It may just be a case that there were no such investments, but that was the case 6 or 7 months ago. I would have to ask them again to make sure now that that's the case. Does someone else want to answer the questions about the carbon bubble and or is that you want me to? You got it, Neil? Okay. I'll do the Apereo one.
Okay. So yeah, on the carbon bubble, is something that we talked about, and the basic notion here is that these fossil energy companies, a big part of their value is their reserves, their holdings of coal, oil, natural gas reserves, okay? And the question is if we're going to be entering a future era in which finally some kind of national federal action is taken, international action is taken to try and get the world and the U.S. to use less fossil energy, okay, is really going to constrain that, then very likely those reserves are overvalued today at current prices. And so that presents a risk to our endowment if we are holding companies which are overvalued. And so that's something which investors are aware of that conversation. My sense is they're monitoring that. They're looking at it and will kind of keep sort of their fingers on that, but at this point it's not such, my understanding is like it's some corporations they have shied away from to the extent that they can. I mean, they have other managers doing this, but they're managing sort of that risk in some sense of they're aware of it. So it's not such that they've decided this is such a big risk we need to completely have zero position in fossil energy. But it may well be when you looked at those averages, the S&P is at 10%, we're more at 4%. Part of that may be sort of the sense of we don't want to have as much exposure to that carbon bubble as the rest of the market. So it's part of the conversation.
Yeah, I can speak that Will and I, and as well as Steve, had a conversation with John Hill, who is a manager at Investor, about the main point was about the carbon bubble. And he was very aware of this this being a coming problem, and that there is literature out there supporting the fact that there is a carbon bubble, and that he said that his the investment managers were aware of this problem as well, and that it was kind of a they do this for a living type of thing, and that they're very good at what they do, and so we should have faith that they are doing their due diligence and research in the next bubbles that are coming and the next trends that are coming. But he seemed aware of this problem when we addressed it.
I would just add that we talked a lot about investments in coal, and it was Mr. Hill's opinion, and it does bear out in the numbers. I didn't show you what our investments in coal were, but when we started this process, I think 0.3% of our endowment was invested in coal, and they sold the major holding in coal about halfway through this process. And frankly, it had a lot to do with that. And I think the regulatory pressures on coal are probably greater than on other fossil fuels. It is the dirtiest. And it was his opinion that you're already seeing divestment from that. And I think that our lower figure in fossil fuels is probably reflective of the fact that they are having more trouble finding viable investments in fossil fuels.
Yeah. I'd just like to add to that you know, the carbon bubble, I think it's on investors' radar. In my personal opinion, I don't think it's on their radar enough, and that we still have fossil fuel investments. But I think that over time, we're going to see investors going to have to divest under natural market forces, whether or not these other institutions want to or not, based on their own beliefs. I think investors are going to have to, and it's just a matter of when. That it's not going to be because, you know, the orange square kids are, you know, pounding at the door, but it's going to be because it doesn't make economic sense anymore to invest in these fossil fuel companies. So to me, I just hope that's a lot sooner rather than later, and that, you know, that the effect of the carbon bubble will be realized sooner, and that investor will, and other managers, not just investors, that everyone will get on board and recognize this, and then divestment will happen through market forces. But I don't know.
Can I make a return comment? Just very quickly.
Sure.
Thank you very much, and I'm really relieved that you are having these conversations already. I just wanted, weirdly to you, Will, defend the Orange Square kids, because I think one of the things that we forget when we talk about economic forces, we tend to think that those are forces that are created by some kind of impersonal market efficiency. But bubbles are created by stories. One story is fossil fuels are forever, and they're not going anywhere, and so their share price stays high. Another story is we should look at them hard. I think part of the reason that people are looking at the carbon bubble is because of the divestment movement, right? Divestment is changing the story by having people look at these stocks and question them. And so I just want to make sure that the people in the room understand the direction of change. I spent a lot of time in history saying the direction of change is from the bottom, often, right? Not to call you the bottom. But go Orange Square kids.
Thank you, thank you.
I saw Will with an orange square on one time.
And I think that's a very, very fair point, and I think that, you know, what I would convey to you, I can't speak for everyone on the task force, but I've heard Alice Handy, the head of Investor, a few times in board presentations, pretty technical stuff about returns and that kind of thing. But our session was the first time where I really heard her from the heart speaking. I found her very compelling in terms of hearing this message. She knows her client base is going to be at the forefront of this. They are investing in a sustainability investments analyst. They're spending more time on it. There are difficulties in getting out of where they are today, but I think she hears us loud and clear. And I felt like she was far more engaged in the issue than I expected her to be, frankly. And her coming up here for a meeting of our committee with a couple of her key people, I thought said a lot too. And so I just want to make sure that you get the sense that they're not holding us off like this. I think they're embracing the conversation. There are difficulties around it, and I think Will is right that over time it's gonna get there.
And I think it's also worth emphasizing something that Emily said, which is the conversation is not over.
Absolutely.
And that's our view, that's Alice Handy's view, that's investors' view, is that the conversation is something that will need to continue and really doesn't have an end. This is not an issue that goes away. This is something that we're going to be working with for a while.
I don't want to forget about Emily's question on the Aperio report. And for those of you who haven't read it, there was a report done where they compared the returns on a divested portfolio to those of the Russell 3000 index. And that's actually the key to understanding it. I think the difference was negligible. I don't know if I can't remember for sure whether the divested portfolio was a little bit higher or might have been a little bit lower, 0.04% or something like that. But the key to understand is the benchmark. They compared it to the Russell 3000, which is a market index. And the returns on the Russell 3000, I can put them on our website because I don't have them handy right now. But they're probably in the neighborhood of those 50th percentile returns that we had up there. And we have consistently beat the Russell 3000 index year after year. So to use that as a basis for comparison, it doesn't really compare to the returns that we've been receiving.
But also where the Aperio Group report falls short is that it's not taking into account us leaving Investor. And so that's, I think it would be really challenging for us to, as was shown in the presentation, to get those equal returns if we left Investor to divest. But I'm hopeful that we're going to see in the next few years someone's going to figure out a way to invest responsibly, socially and environmentally responsibly, and get these high returns. I mean, that's my hope. I don't know if it's going to happen, but the hope would be that, you know, theoretically, you could still be in the 90th percentile and be investing responsibly. You know.
Yes.
Hello, I'm Peter Solar, senior journalist, environmentalist. As I recognize the carbon bubble is a big problem, but I want to talk about the student debt bubble and specifically tuition. And I just have a question of like why tuition, not just at Dickinson, but like in higher education in general, seems to be rising all the time. And is there some type of way that we can reduce tuition costs by somehow like reallocating funds and other aspects of the school and the endowment to like somehow like counteract that? Because once there's a critical mass of students who can't pay back their loans, then that's another bubble similar to like the housing crash back in 2008. And is the popping of that bubble not an existential threat to the viability of Dickinson? Yeah.
We didn't talk too much about the student debt bubble, but my first reaction to that would be that the best way to remedy that would be to grow the endowment. You see institutions like, I believe that Princeton, the that if you have any need, you do not pay tuition. And that the only reason they are able to do that is because they have a gigantic endowment that's financially viable for them to actually be able to do that. So if we want to increase the discount rate so that more students can receive financial aid and that tuition can go lower for the average student, there needs to be a larger endowment and larger returns off of that endowment.
I would say to you that, yes, the answer to your question, it's probably the single subject that trustees spend more time on than any other subject. The financial viability of a liberal arts education is right at the top, and you're right, the curve, it continues. And it's challenging, and we try everything we can to keep it under control. I think the institution got through the 2008 crisis because everyone came together and saved a lot of money. It's a very tough question because some of the numbers that you saw from Steve, that increase of our spending in financial aid has attracted a much better student body over the last 10 to 12 years. We continue to improve on that. Financial aid and the discount rate you saw are fundamental to that. So we have, we're pushing for that all the time. The other two big costs of an institution like this are people, between the faculty and the staff, administration, all the support folks, and the infrastructure. These buildings take an awful lot to run and maintain. And those are the three big things. And it's of concern to us. It's a concern across the board, I think, to liberal arts and higher education. I can only tell you that we spend as much time as possible trying to think of innovative ways to keep ourselves in the game, but it's tough. There's no question about it. I think the good news for Dickinson, as you saw, is that as ours has been increasing, especially in recent years, the quality of our education, the quality of our faculty, the quality of our students has gone, I would say, at a pace probably exceeding that curve, and that's the only kind of solace you can take in it.
Hello, Maria Bruno from the Anthropology and Archaeology Department. So kind of along those lines and what Emily was talking, and Steve's presentation was prefaced with the fact that in higher education, bold action will be needed in order to kind of address these growing issues. And I was just wondering, in the presentation, we saw what our stock portfolio does. And I feel like that's actually a very status quo perspective of what we're doing towards the future, right? That's something that we've been doing and we're going to continue to do. Everyone does, and it seems actually not creative at all, just to kind of depend on that and assume that these things are going to keep growing and that fossil fuels are lucrative. And I was just wondering if you guys have explored some other revenue sources, or what the implications would be if we took a bold action like to divest, in terms of donations to the school, attracting students who find this very important to them and would be willing to come here and pay full tuition to attend a school that would take such a bold action. Other kinds of contributions that we would get that may not be stock market dependent, but large donations that could be put to other investments in renewable energies and other ways to make it a cleaner campus in general. So I feel like we hear a lot about the stock investments, but I would like to hear a little bit more about bold actions that might attract, if you've considered, or if we could crunch any numbers on what some positive returns might be for taking a bold action.
Yeah, I think that's an excellent point, that we are doing a lot of things on a lot of fronts that address some of your questions. I'll leave the issue of different revenue sources to those who know more about it, but the main revenue source that we have is those tuition, room, and board fees, which we just heard about as, we've pushed those about as far as we can and should. And so that's our main other revenue source. Can we be creative about other ones? Yes, but we're limited there. Just like to share with you some information about sort of what has Dickinson sort of invested in a variety of ways in sustainability related things. So we put together this summer some data on, so for the past fiscal year 2013, spending on the Climate Action Plan. was about $360,000. The cumulative amount we've spent from 2007 until 2013 is close to $12 million. Now, a big chunk of that, part of this is big chunk of that is a central energy plant, which is a very highly efficient facility. But we've counted sort of within that $11 million, $12 million, the full cost of it, rather than sort of what's the incremental cost of having gone with a very high efficient, low energy using, which means fewer emission kind of facility. Do you count 10% of that cost to it? But so for these, it's a little exaggerated on that, but just to give you a sense of, scale of some of the things that we're spending on resources that are helping to reduce our carbon footprint. Looking at academic programs, and this is just very simply looking at, if we only count environmental studies program, the Center for Sustainability Education, the GIS lab, expenditures on that is about $1.2 million a year. Cumulatively, it's $5.5 million since 2007. If we counted the amount of time faculty such as yourself who teach about environment, sustainability related things, climate change, that figure would climb quite a bit, but we decided that would be not a useful thing to measure, but there's a lot of faculty effort, a lot of academic programs that tie into this that we're not counting. So that's a little sense of what's going on there. Looking to the future is we've been looking at our climate action plan very carefully this past year, and have looked at things that we can do to really reduce our emissions of greenhouse gases. To get at, for me, that's sort of the core issue is whatever we do, whether it's a divestment strategy, whether it's other things, bottom line, what we need to do is reduce the amount of carbon that goes in the atmosphere. So we can have a very direct effect on emissions that come from operating this campus. And so we've got a set of projects we've identified that can get us to a target that we've set of 25% reduction in our emissions below the 2008 level, get that 25% reduction by the year 2020. And these projects would have a cumulative cost of around $3.5 million. Where do we get those funds? How do we pay for them? Well, those are projects which reduce our utility expenditures. Okay, they reduce the amount we're spending on electricity, on natural gas, other sources of energy. So we're looking at and have proposed to planning and budget the idea of starting off with a set amount of these projects that will have short payback periods, get us significant savings in the first year, invest those into a fund so the savings on our utilities, rather than spreading it across all programs at the college, we reserve that to invest in another set of projects the following year to get further reductions, accumulate more savings, use that to invest in another one. And so by building those savings in utility costs, doing some really, I think, bold things on our emissions footprint. So that's I think, a big part of what Dickinson is doing, which we can be very proud of.
I'd like to add another dimension to the bold, because I think, Maria, what I heard in your question was a broader question. And I think the bold step that Dickinson took and continues to take is its commitment to sustainability throughout the college. It is a Dickinson dimension now, and that means that we are seen increasingly as a leader. And when you actually look at all the different ways, not just in teaching, but in students who help put on the solar panels, the college farm, when you listen to Ken Schultes and actually see some of these things, you know that took a lot of risk, continues to be a risk, but has also increased the number of students who come to Dickinson particularly for that. And I think one of the challenges for us is to keep that commitment out in front. And that has been one of the creative ways the task force is thinking, because I understand that if we're going to be a leader, we have to continue to be a leader. And that means these questions, whether it's the carbon bubble or continuing to talk to Investure about principles for sustainable investment, that's part of the integrity of being this leader. And I think that that's something we take very seriously.
Well said. And I just would like to add that from the trustee perspective, I know from my learning through this process, that, will be one of the loudest and clearest messages to the trustees, administration, and imploring budget and planning as well. Even this is a truly distinctive part of what we're doing. It's the right thing to be doing. We are moving the needle, and we need to continue it. Professor Donaldson said it exactly right. We have to push for that. I would also just say that I think that the activities done on campus already has attracted a lot of donations based on what has been done around LEED certification, the buildings that are here, from Rector to Kaufman to the admissions house, Alt House, all attracted very strong donations that I think were strongly supported by this base foundation of our sustainability and doing the buildings right, from the perspective of what we see anyway, and will continue to do so because there's a lot of interest from the alumni base in that, and I think we're attracting dollars as a part of it, and will be important for that, for staying competitive as well.
Just to answer the other part of what I understood to be your question, Maria, part of our work plan did involve discussions on the admissions impact, or the likely admissions impact of divestment, as well as the likely fundraising impacts of divestment. Stephanie Ballmer came and spoke with us. She did reach out to her colleagues at the other institutions that had made the divestment decision. And at this point, it was too early in the game for them to have any hard data on what impact, if any, that they saw from that. Chris Van Buskirk came and talked about the fundraising experience related to sustainability, and yes, she did have some successes to report, but she also reported that, their feelers indicated that they might get a lot of concerns from people who donate their money to the college with an assumption that it will be invested to yield a maximum return, and that it could just as easily have negative consequences with it as well.
Yeah, I'd just like to add one thing in that I think everything we've done so far is really great, and it's part of the reason I'm here. But to me, I almost see it as an expectation and something we should be doing, and something that just makes so much sense on so many levels. That the reason facilities, started doing things like developing a climate action plan and putting together a revolving loan fund idea is it makes financial sense. I mean, it's crazy to be wasting water and wasting electricity because it costs money, and we can save money and put more towards our students if we can save money for the college. So to me, that's almost like an expectation that we should be working on those things and we should be developing those things. So to me, that's action. It's not bold. And something that would be bold would be stepping out and saying, we're divesting, we don't care about some of these negative side effects, but they're really, I think in this case, the negatives outweigh the boldness that the positives that we could get from that. So I think there are definitely, I don't want to say there aren't things that we're doing that aren't a little bold, but nothing as bold as saying we're divesting and, we're going to be the first really prominent institution with rigorous academics to divest. So I probably made some people angry with that, but. I'm
going to lose your orange square.
Yes.
Hey, my name is Lin Wei Cheng, and I'm a Chinese international student majoring in business and political science. I understand that it is difficult to divest, but I'm thinking maybe because now there are organizations working on sustainability indexes in investment. So do you think investor is taking any action on that, and do you think Dickinson will issue reports on that and just communicate their progress on this? Because that also goes back to what we were talking about, the carbon bubbles. So, by issuing these reports with students and as well as the stakeholders, they can see a continuous progress on this in this area.
Anybody like that one? Go ahead. Yeah.
Well, very definitely, there's, and this was partly at conversations that Dickinson was part of, Middlebury was part of, in which Investor has set up a sustainability fund within their program. And so one of the things that we can do within Investure is make decisions about what portion of our portfolio of what we invest with Investure, of some portion of that going to the sustainability fund, okay, which has a variety of standards of what qualifies for that. Steve would know the exact number of what we've put into that, but that's something where there's been discussion about how to make that fund grow, be more attractive to the members of the Investure Consortium, and start emphasizing that, but within the context of finding corporations, equity opportunities in which you can do that with a rate of return that is comparable to what you could do elsewhere. But that is part of an active conversation in Investure.
And we've committed about $3.2 million to the Sustainability Fund. The other Investure clients that committed to the Sustainability Fund were Middlebury and the Rockefeller Brothers Fund. It was offered to everybody, but only those three did commit. And actually, Rockefeller Brothers Fund is going to be leaving the Investor Consortium. They have made that decision to do so. And there may be an opportunity when they leave to increase our commitment to the Sustainability Fund, and that's something we've been talking about as a task force as well.
Something that I would like to mention is that Investure is currently actively recruiting a sustainability analyst to look at investments from the position of from environmental, social and justice sustainability, or in governance sustainability. So, and I feel safe in saying that a lot of that action is because of the political push from both Middlebury and Dickinson College. So I believe that Dickinson, through this conversation and through this action, has really made a change within this consortium and is making a positive change.
I'll tell you this because Will make you angry by making his statement recently. He's been a very strong advocate, and I said this at our last meeting, but I think he deserves for me to say this publicly. The people at Investure can't stand him. He sends them emails, he asks them questions, he challenges their information, so he has been a very strong advocate. And I think Adam's correct. We in Middlebury right now are going to be the only ones in the Sustainability Fund. We are the ones that have been pushing those actions, so it has had an impact, and I would say that Will himself has had an impact on Investure.
Michael?
Just as a little bit of an overview, the themes that we have encountered today so far reflect perhaps the three ways that an organization can be a responsible investor. One is to do negative screening, and that, of course, is the divestment from oil companies discussion, and there, I think, are legitimate constraints to that, as we have heard. The second is to seek to do positive screening, to seek the sustainable investments, and as just suggested, Dickinson is active there. A second way is to be an activist shareholder, in theory, but we've also heard that due to the structure of the endowment, it's really not possible for us quite individually to be so activist as shareholders, but nonetheless, Dickinson, in its engagement with Investure, as you have just heard, has been a very demanding client. And there is some literature, some business literature, that suggests that a demanding client can make an enormous impact on a provider of services such as Investure, and I think that Dickinson has had that kind of impact. A bit more broadly, something bold, I think, that's not been touched upon today quite so much, is the movement to divest is really one focused on the supply side of the market. And I think that there's an enormous responsibility for we on the demand side of energy utilization. And that, of course, provides an opportunity to talk about what we do in this community, how we, over the past few years, as we become more sensitized, have taken steps individually to, from the bottom up, to conserve. And perhaps as well, is it possible for college communities to begin to lobby political process to overcome the market failure? The price of energy is not fully reflected in market prices. And to the extent that loud voices might somehow come together to advocate more clearly for a correction of that fact might be important. And then the third way, again, is also reflected here, and that is that an organization makes local engagements, local investments. And something not mentioned is that even beyond these walls, Neil Leary, for example, is now working as part of the Carlisle project, and that is an attempt to organize a network of agents within Carlisle, Greater Carlisle, to consider what sustainability means and how we can all do that collectively. So there are many dimensions here that are in play across the social, economic, and environmental arenas.
Yeah. Thank you, Michael.
Hi, my name is Anna McGinn. I'm a senior environmental studies major, and I have two questions. One was just came up, and I don't think everyone needs to answer it, but so I'm curious. It seems like, given all of the information that Mr. Hitch showed, it makes zero sense to leave Investure. They are doing very well for us, and that's pretty clear. I'm wondering if you could speak to why Rockefeller Brothers left Investure, because that seems kind of odd given how well Investure is doing. Yeah, that's the first question. Maybe, and then I can.
They left over the fossil fuel issue.
So, given that, is there a model that we could follow, perhaps, that they are doing now that would be something that Dickinson would consider?
Thus far, they don't seem to have a real solid game plan. They've just decided that the divestment issue is that important to them that they're willing to sacrifice the returns. I would say also, off the top of my head, I can't remember what kind of assets they have, but they are larger than us. I think it's somewhere in the range of 800 million to $1 billion. So their choices as far as finding another investment firm would be greater than ours, but I think they're going to have a lot of difficulty, and I think they're finding that already, that they just don't know what they are going to do. I'm not sure they thought the thing the whole way through before they made the decision.
But it is fair to keep our eye on them and what they're doing. There's no question about it. And they're gonna be around Investor for a long time, because it takes a long time to unwind these positions. So I think we'll have an opportunity to learn probably through Investor, as well as perhaps making direct contact with them. Fair point.
As a foundation, too, they have a greater ability to control their expenditures. They give out grants. They can simply lower the amount of grants that they give out if their earnings are lower. It would be much more difficult for us to lower our expenditures.
Precisely.
Okay, so I guess the second part of my question is that it really struck me, the conversation on what kind of impact we can have on investors. So obviously we can't say we would like you to divest, and then that will cause them to divest because of all of the other parties that they're considering. But I'd like to think that we still have a voice in how our money is invested, although there are other institutions involved. So I'm wondering if there are ways that Dickinson can push Investor to consider how their managers are investing their money. And so it's my understanding that one of Investor's major issues with this is that divestment would restrict their managers from what they can invest in. And I'm just wondering and this is a question that goes back to values, and I think that it's something, despite the fact that values are a gray area, I think that when Dickinson makes this decision, it is a value that we're stating, and that is something that the rest of the world is going to see. So I think that's something that needs to be considered, despite the fact there are disagreements. But I'm wondering, what's the cost-benefit analysis of asking managers to not invest in just 200 companies versus the serious implications of climate change? And is there a way that we can reconcile this?
I think, well, first of all, we can't, unless all of the Investor members agree, we cannot ask the investors or the managers to not invest in those 200 companies. But unless I'm mistaken, there's an implicit assumption here that divestment would lead to some kind of positive consequence with the fossil fuels industry. And I don't know. We've talked about that. I'm not sure anybody's convinced that that would happen. And so then you have to ask yourself, what is the end game of the strategy? What's the goal, and what are we accomplishing? yes, we would make a statement, but would it really impact the fossil fuel industry? And a lot of our discussions have been, we would like to focus our resources, we would like to focus our energy on changes here on campus that would impact our consumption and have a direct impact upon the fossil fuel industry. We would like to focus our resources on continuing to make sustainability a large part of our curriculum so that we are educating people about sustainability and advancing that cause throughout the globe. I think just looking at the finances really only looks at one piece of the equation.
Yeah, I want to speak to that. Of course, I think the values are central in this issue. And I think the challenge is to be really clear about what those values are and to have a sense of integrity. And I think from what I have found working on this task force, investors not the enemy. I would have liked it if I could have said, these are the bad guys, and we have to slay the dragon, take this bold move. It's not that way, and nor is it the way that the conversation is ending. I think the fact that Will is the grain of sand in the shoe or the pearl or whatever metaphor you want to use there, I think investor really understands that we have a value of reducing our carbon emissions. We have a value for making sustainable investments, and the 1.1% that are invested in these top 200 companies, we would like to see those invested someplace else. So the value issue, the commitment to a sustainable world, a value that says climate change is real and we have responsibilities about that, those values are not fuzzy, in my view, and are stated every day in what we tell people. And this, walking the talk that I think is about integrity is something that's, in my view, is going to continue throughout the conversations with investor. It's simply not necessarily the case that you have to have good guys and bad guys. The commitment of the college, the Finance and Budget Committee, and the Endowment Committee is to increase the yield on our endowment to benefit students. I'm committed to the fact that we can do that without sacrificing our commitment to responsible action in the face of devastating climate change.
I'm leaving, and I would love to make a plea. Can I make a plea? I have to teach, that's why I'm leaving. It's not insufficient commitment. They'll be confused if I'm not there. So, once again, valuable and interesting conversation, reassuring that we are changing investor slowly through grains of sand. Thank you, Will. Awesome. I want to raise the point that the reason I think that so many of us are interested in divestment is that divestment is the only national level political conversation on climate change going. And at the moment I can think of, there's Keystone and there's divestment, right? And I'm wondering, by giving up the idea of publicly divesting as opposed to kind of slowly forcing investor to change, we're giving up the chance to make a statement in those political debates instead of just listening to them. We're quite good at listening to them. We have a lot of people come here and we listen a lot. And I was just wondering if the committee could think about other ways. I mean, I appreciate that we are changing the college. I appreciate that we are changing the ways in which we consume energy and building a better landscape and building a better community. But we know that climate change activism has to happen in multiple levels. And I'm wondering if the community or the committee could think about ways in which we could also make statements. And I'm just sort of bouncing a little bit off what Michael said, because I feel like that's what we're giving up if we don't do this right now. And now I'm making a statement and storming out, but only because I have students waiting for me in Denny Hall. So.
One of the things that Yeah, there've been obviously other schools that have discussed this. Go, Emily, I don't want to hold you up. There have been other schools that have discussed this and have gone through, I don't know if it's a similar process to ours, but they've gone through some form of dialogue on campus. And, you know, Swarthmore's one of them, Middlebury's another. And one of the things that they've pointed out, and I think it's worth consideration, is, and I'll use this word simply because somebody sent me an email using this word. They asked about the hypocrisy of talking about sustainability here on campus, but then not divesting. And it was ironic because it was either Middlebury or Swarthmore or both that talked about the hypocrisy of divesting when we are continuing to consume fossil fuels on our campuses. And we've heard a lot about apartheid. In fact, I think we got some questions about apartheid. And my mind tends to work in analogies, and I almost think that divesting from fossil fuels, when we continue to be consumers of fossil fuels, is analogous to, you know, back in the 1980s, had we divested from South Africa but continued to practice institutional racism. And so, you know, we can debate these things forever. They're matters of opinion, and I don't know that we'd ever get to an answer, but there's all kinds of different ways to look at the value statement and the hypocrisy statement.
Maybe just before Justin asks his question, just to follow on Emily's request for us to think about bold statements, I think there's another conversation which we're part of to do that. I think becoming an institution that has zero net emissions of greenhouse gases is an extraordinarily powerful statement, because ultimately that's what needs to happen. When you divest from fossil energy companies, that doesn't change a relationship so much with the fossil energy sector. We would be selling shares that are owned through Investure to other people. It doesn't provide new capital to the fossil energy industry. What does provide them more revenues and capital is we spend $3 million a year on fossil energy. There's where we can make our big statement. How do we reduce that as much as we possibly can?
Sorry, I have to go to lab to talk about oil and natural gas, and so I'm gonna.
Others may need to excuse themselves. Justin, we'll take yours.
So my question is about throughout the whole conversation, ever since the first meeting in the boardroom, Mr. Kolaris spoke on not politicizing the endowment and making our impact through that decision. So in 1835, Oberlin College decided to get away with, they chose to do blind race admissions, and that changed the conversation on abolition. Wow. And this was a risk. Man. If we chose to divest, would that change the national conversation on climate change? We could have that impact.
I think that's a very fair statement. I think I would react that we've had a lot of conversations around that, and you know, I think it's a very big leap for the college to take that risk right now. And I think a lot of the things that we're talking about doing get us there. Perhaps it's not bold enough by some standards, but I think we are engaged in the right direction. And I don't think making the statement to be a national leader on that is worth the risk that we're putting ourselves under to keep this institution going at the standards we expect of it.
Yeah, I actually have to say that there's another point for me, and what you brought up is really, really powerful, and that, you know, in retrospect, you can see that happened. Honestly, as a student and scholar of culture, religion and culture and change, the bold statement isn't divesting. We have one 1.1% of our funds invested in the top 200 companies. The statement that we've divested in that is minuscule in my view when you compare it to the 28% of endowment funds invested in apartheid. The cultural situations are extraordinarily different. Our times are extraordinarily different. To have Dickinson College try to make this bold statement, we've divested in fossil fuels, I don't think has the cachet or the boldness that reducing our carbon footprint does. But 10 years from now, I may be completely wrong about that. The current climate in the United States at this time, and as much as I love Bill McKibben, divestment is not the bold statement. And I'm way out on a limb on this. But I read it and I don't see that the divestment of 1.1 of our funds is going to make the bold statement that you're talking about. The bold statement comes in committing to the planet and our future by reducing our carbon footprint.
One last question? Yep.
Thank you. My name's Sam Bogan. I'm a sophomore, proud Orange Square wearer, and my question is concerning the triple bottom line policy that the college has on managing its investments. It states that decisions based on managing our finances should be financially, environmentally, and socially sustainable. And in this conversation, it's been really clear that the decision not to divest is certainly financially sustainable. Neil's answer about how having lucrative returns on an endowment would allow us to make bold moves on an environmental level is very, very critical, and I really appreciate that answer. That was great. But nowhere in this conversation have we really addressed the social sustainability side of this. Adam mentioned the term social justice once. That was the only time it was actually even considered. But I would hope that in the statement, I'm pretty sure in January that's going to come out on your decision, that all three of those all three factors of the triple bottom line will be taken into account. So my question is just, how do you plan on addressing the issue of social sustainability when the fossil fuel industry is so socially destructive?
I think the best way to look at the triple bottom line strategy is to view it not just in terms of our endowment and our investments there, but the institution-wide investments of all our resources. And you're right. The number one goal on the endowment is economic. The other two legs of the triple bottom line, so to speak, are the social, as in people, and the environmental, as in planet. And they oftentimes call it the 3 Ps: people, planet, and profit. We talked about the social part when we looked at the institutional financial aid that we give out every year. We are not purely motivated by the bottom line, otherwise we would go 100% for full pay students and we wouldn't give out $40 million in institutional aid every year. We make contributions socially as well through the curriculum and the way in which we prepare students, and the finances make that possible. And then environmentally, I think we pay attention to that leg through the actions that we take here on campus. And I actually do have a graphic. I brought this because I anticipated this question.
Did you want to add anything on that?
While I'm going to make an announcement, I got an email from my boss. He was not 100% sure that the Rockefeller Brothers Fund decision is public yet.
Oops.
I guess it is
He
now.
asked for me to ask you, please don't run with that information. I'm not sure what it is or not. It was made several months ago. I know when Alice Handy was here in July, she had told the task force about it. I made an assumption that by this time it was public, but it may in fact not be. Maybe Keith or Sean. I'm not aware of it. All right, well, you
All right, cone of silence, everyone.
you heard it here first.
A bold statement at Dickinson College.
I kind of like this topic because the point that it makes is that you've got to make compromises, you've got to balance all three, the people, the planet, and the profit. And in the center there where they all intersect is a sustainable decision, and that's an optimal decision. And we arrive at this sustainable decision through dialogue and collaboration. And everybody comes at it with their own set of priorities, everybody comes at it with their own perspective. And for some people it may be profit, for some people it may be planet, for some people it may be people. But the ultimate and the most sustainable action is going to be one that balances all three of those. And while we absolutely are tilted toward the profit side on our endowment, and I wouldn't say completely, because I think we have done some things with our endowment that are socially responsible, that are environmentally responsible. I will not deny, though, that that is the number one focus. I'm hoping that we do a good job as an institution with those returns that we do earn of distributing our resources to pay equal attention to all three legs of the triple bottom line.
Just to talk about the social sustainability portion. When you look at the pillars of sustainability, you have social, fiscal, and environmental. And social sustainability is the hardest to define. And so when you look at Dickinson being a socially sustainable institution, it's hard to answer that question because it's hard to define exactly what the question is being asked. So you could look at the social and sustainable investments into the community, like the Greater Carlisle Project or Project Share. But the way I chose to look at this was the social sustainable investment made into the students. That the greatest investment that Dickinson's making is into each and every one of us, or the Orange Patch Wearing kids, and myself. And I know that here, that even in the economics department, which there are a few questions about economics as an institution by a few people, I know that Dickinson puts an emphasis on heterodox economics that looks at the broader question of economics, that looks at economics not just as a graph, but as real life, looking at case studies, looking at how people can make a change in the world and how everyone's needs can be incorporated into the idea of economics. I can say that there are multiple outreaches to Dickinson students through things like the Clark Forum, through things like the Public Affairs Committee, through departmental chairs, through safe space training that make us more responsible social citizens. I can talk about how we have internships and opportunities through the farm, through Alarm, through Neil Leary and the Center for Sustainable Education, through the Office for Community Service. I can talk about how I actually got rejected for a service trip because of how popular service trips are on this campus and how important it is to this campus. Because there's just more demand as a Dickinson student to make these positive impacts than there is supply. Because it's just so important to be, as a partner of a Dickinson student, to make this type of changes. And something that I really want to talk about is the special interest housing. I am a member of the Social Justice House, and I know that when you look at like the Social Justice House, the Tree House, the Feminist Collective, that these are places where people go to really cut their teeth as young activists, to really sharpen their minds, to sharpen their points, to have these important discussions that when we go off into the quote-unquote real world, that we'll be ready to make these positive changes so that we can make these bold statements that need to be made. And so that's something that I really want to, when we talk about socially sustainable investments, I want the Dickinson student body to look inwards to see what's the investment that Dickinson has made in us through the curriculum, through the 50 to 60 sustainability-focused courses that are offered each semester. What is the investment in us, and what can we do with that investment? That's the question that we need to say. And JFK is currently in the news all the time, and so it's not what can Dickinson do for you, but what can you do for the Dickinson, but not so much Dickinson, but the greater world. And it's what has Dickinson done for us, and what can we do for the greater world with the tools provided by us by a Dickinson education? And that's how I would look at that question.
Thank you, Anna. Great. And thank you all.
Can I just have one brief
Sure.
thing on this specifics of the triple bottom line, which shows up on our website as saying that our investments and the way we manage the institution are guided by that. It's not actually an official position policy of the college. It's very vague, and so we did talk about what might be done to make that a less ambiguous policy of the college. We decided that it was sort of beyond the scope of what this task force is charged with, but that what we'll probably do is include within our recommendation something about the need to clarify what that means. Is it in fact a guiding principle of the college, and give it some sort of teeth as to what does it mean to be trying to balance these environmental, social, and fiscal, financial kinds of responsibilities, so that it becomes more tangible, and then we can hold ourselves more accountable by being more specific as to what does that mean. So that wasn't an explicit part of our charge and what we'll do, but part of what will probably come forward is a suggestion that maybe the investment committee or the board or some other body with the proper authority takes a look at this and makes it more concrete.
Precisely. The process has shown the bright light on the, on the issue.
We're out of time. Can I
Yeah.
make one statement?
Sure.
For inclusion in the recommendations, maybe? Hi, so Tony Underwood in economics. I just want to point out that the one thing that will make the carbon budget and the impending carbon bubble binding is to place a price on carbon. Okay? That will make investors make this movement towards a divested portfolio much more quickly.
Thank you. All right, well, thank you all for your engagement and your openness, and special thanks to my colleagues on the task force for your time and commitment and thoughtfulness. Appreciate it. Terrific.
Very nicely said. Really nice.